Hello, investors. We want to thank you for joining us today to talk about our experience in the BSG simulation. We are Team H in Industry 2. We finished in 6th place, had some ups and downs. We're happy to share our experiences with you and want to thank you for writing this out with us. And first, we will turn to our CMO, Seth New, to talk about our initial strategy.
Thank you, Evan. So our initial strategy is three-pronged. First is to have above average quality and above average prices. So really targeting that sweet spot. We compare ourselves to the Johnston and Murphy of the shoe industry. Secondly, invest internally instead of adding additional capacity. We wanted to invest in production runs and in the quality of materials, and also doing some certain things to lower our cost, like best practices training as well as Six Sigma TQM training. And then lastly was to win in Europe. We calculated that Europe would have the highest demand over the 6-year period, and we anticipated that other competitors would overlook this fact. That we would also have the ability to charge higher prices in Europe. So the question is, how did it work out? And really, not as well as we wanted to, and that's for 4 reasons that we have here. The first is the initial investment that we had in our plants in quality really forced our hand to take advantage of that investment. Second is that from a competitive standpoint, there were a lot of competitors that were in a similar space. We anticipated and hoped that the competitors would space out, but you'll hear a little bit more about that when Monish goes into it. And third, our perceptions of quality. We did not understand or take into account how the perceptions of quality would be taken from a customer standpoint versus the quality of how quality the shoe is and how that came out with branding. And then lastly, the inability to forecast our competitors' decisions really had an impact on our own forecasts. We had an overconfidence bias in projecting our averages and where they would fall, and this really had a negative effect on how our forecasts came out. So next I'm going to hand it over to our COO, Monish.
Thanks, Seth. So with respect to the competitive landscape that we were dealing with, the main point to make would be that there was a huge overcapacity in the industry. At one point, we were talking about an excess of 70%, and that was because of our competitors insisting on building more capacity and more plants in geographies. What this did was have a downward pressure on prices, both wholesale as well as internet. And since we were positioned to be a high quality player in the market, our production costs were really high. So we had to charge commensurate prices for us to be able to clear our inventory and make margin, which we were not able to do because of the downward trend in prices. Next, the way the game was set up was that there was no entry and exit, which sort of made it that all competitors were competing in all geographies right till the end. This is a slight variation from the real world where companies would choose to exit from certain markets. The race for differentiation caused a high number of models in the industry, and since we were a high quality player, the production costs of setting up 500 models were too high for us to sustain. We felt that teams B, D, and G were our 3 main competitors, and so was Team F. But since Team F's pricing was so erratic, it made it difficult for us to clear our inventory and make a profit. The pivot points that we felt were in the game were that after our first round, after the failure of our initial strategy, we sought out white space with respect to quality, and this had success initially, but rising costs made us again not able to compete on margins. In the later part of the game, we scaled back on quality, thus lowering costs. But at that particular point of time, it was too late for us to get a leading position in the industry. Also, and finally, we realized the value of celebrity appeal and marketing too late. But once we did, we did better than we were doing in previous rounds. I'll now hand over to Evan to speak about our successes and failures.
Thanks, Monish. I always like to start off with the bad news first, so I'll talk about the failures. And we really thought there were sort of 4 of them that cost us in the game and negated better EPS and ROE. First of all, I thought we really underestimated the exchange rate volatility. We thought maybe when our strategy to win Europe, we might have a swing of $4 or $5, but we did not anticipate $15, $16 a shoe and 15 to 16%, and that negated our strategy of winning Europe and producing in Asia. Secondly, and Seth talked about this a lot, but we really thought that SQ would just drive sales and that there would be a direct correlation. That ended up not happening. We sort of needed more marketing to influence that, and essentially what we ended up doing, we were using these high quality materials and just adding costs without reaping any consumer benefit. Consumers didn't realize we were producing 8, 9, 10 star quality shoes. Thirdly, we consistently anticipated that our competitors would sort of scale back on their capacity, and this had sort of really cumulative effects. Monish talked about this a lot with inventory problems. We were up at over 1 million shoes consistently in our inventory. We were not making good margins on these, and this also put a lot of downward pressure on price wars. We kept thinking that this would change, and that was informing our averages, and it just didn't work out, and people kept expanding capacity. And finally, we really took too long to recognize to spread our fixed costs too much, or to spread our fixed costs. Essentially, our margins were way too low the entire game, and we need to find a way to fix this. And when we did, it was a little too late. Really, I thought we did well in 3 areas, which is we avoided the capacity arms race while other teams were racing to buy plants or capacity. We were the first ones to sell, and so we didn't get involved in this and make any terrible investments. Secondly, we thought we did really well in sort of risk management and avoiding private label market. If you were off by a penny, you weren't going to get these. So we were able to stay away from that low margin, high risk game. Finally, we had really one good round in round 3 where we increased EPS and ROE. I thought we did this really well as a team, where we found sort of the balance between quality, model availability, and price, especially as it related to competitors. We were able to do well that round, but just not sustain it as we're not predicting our competitors well enough. With that, thank you, and I'm going to turn it over to Steve to wrap it up today.
Thank you, Evan. So the 2 parts I'm going to talk about are what could we have done differently and what coordination problems or biases led to that. I'll just quickly hit on what we could have done differently because my 3 counterparts have already discussed it, but it's really 5 things. The first 2 are customer facing. One being we could have lowered quality, focused on more economies of scale and higher sales to bring down those margins. The second would have been our messaging, getting the word out that our higher quality is worth paying for, and getting consumers to buy the shoes. The other 3 are more internally focused. As we recognized that supply was exceeding demand, we could have sold capacity earlier. In the same vein, recognized we wouldn't need all of our capacity through the game. We could have upgraded one of our plants instead of both. We made significant investments in both plants, which we were not able to recover those costs. And then the third is to Monish's point about consistent high, million unit plus inventories. We really could have recognized that supply was overshooting demand earlier, and in our branded production and distribution gone for much lower output and reduce those inventory builds throughout the game. So those are kind of 5 takeaways we got and what we could have done differently. In terms of coordination problems and biases, I really want to hit 3 main points. The first 2 are biases that we discussed in class, one being the saliency bias. I think that to some degree the marketing simulation that we did in the core class last year gave me and perhaps some others the idea that higher prices is better. And in this game, without getting the appropriate sales, that is not necessarily better. And the second was an overconfidence bias. In the first round, and actually the first several rounds, we set projections to match our production and distribution based on what we thought the industry would be doing overall, when in turn we were not very good at estimating what the industry would do overall. Finally, I think that we focused a little bit more on rigorous quantitative analysis to understand the market demand and how to price appropriately, and less on some of the game theory about what our competitors would be doing in the marketplace and making decisions based on that. So if we had it to do over again, we might have been a little less focused on really trying to quantitatively understand demand and more on how is the market going to react. With that in mind, we appreciate the opportunity to work in this game. We think that it was a fundamental capstone experience. With no ability to take questions, we'll conclude here and say thanks.